What if the very thing most immigrants fear, debt, is the exact tool the wealthiest people in North America use to build generational wealth? What if the system you were warned about was actually designed to reward those who understand it and quietly punish those who don't? The financial game here has rules. Immigrants who learn those rules in their first 5 years buy houses, start businesses, and retire with dignity. Those who don't spend decades working hard and wondering why the dream feels just out of reach. In over 2 decades working with immigrants from Lagos to London, Mumbai to Manila, the single biggest mistake I see isn't gambling or overspending. It's fear of credit. What I'm about to share could change your family's financial trajectory for 3 generations. Let me start with Maria. Maria arrived in Toronto from the Philippines in 2009 with $800 and a nursing degree. She worked double shifts, sent money home, lived frugally, and by 2015 had saved $22,000. But she had no credit history at all. When she tried to buy a condo, the bank said, "No credit history, we can't approve you." She'd done everything right by the rules she grew up with. But those rules were written for a different system. Her co-worker, David, who arrived from Nigeria 2 years later, had already bought a condo and opened a business line of credit. He wasn't richer or smarter. He simply understood that in North America, your credit score is your financial passport. And Maria's $22,000 in savings actually hurt her, in a way I'll explain shortly. What credit actually is. Credit is trust. A bank saying, "We believe you'll pay us back." That trust gets quantified into a 3-digit score. 300 to 900 in Canada. 300 to 850 in the US. That number determines whether you can buy a home, what interest you pay, even whether you get hired. Built not on how hard you work, but on your borrowing history. Most immigrants arrive thinking debt is dangerous. Never borrow what you can't pay in cash. That wisdom is incomplete here, because if you never borrow, the system can't see you. You become financially invisible, and invisibility is a ceiling you can never break through. Step 1. The secured credit card. If you're new here, walk into any bank and ask for a secured credit card. You deposit $200 to $500 as collateral. That becomes your limit, and the bank reports your behavior to the credit bureaus. Within 6 to 12 months, you build a real profile. The key strategy: never use more than 30% of your credit limit, ideally under 10%. Credit utilization is roughly 30% of your score. Lower utilization means a higher score, better interest rates, and real money saved over a lifetime. Tens of thousands on a mortgage alone. CTA. If you found this helpful, hit like and subscribe. I release videos every week to help immigrants decode the North American financial system. The biggest credit myth. Carrying a balance does not build your credit score. That's one of the most expensive myths in personal finance. Carrying a balance just means paying interest, sometimes 20% or more. What actually builds your score is paying the full balance, on time, every single month. Payment history is 35% of your score, the single biggest factor. Miss one payment by 30 days, and your score can drop 50 to 100 points, costing you $30,000 to $50,000 in extra mortgage interest over 25 years. Automate your minimum payment the moment you get any credit product, then pay the rest manually. That 2-step habit protects your score even when life gets chaotic. The psychology of immigrant money. Immigrants tend to bring one of 2 extremes here: extreme frugality, saving everything but refusing to leverage credit out of fear, or relief spending, overspending the moment credit feels like proof you've made it. Both are traps. The frugal saver earns 0 leverage on their savings. The relief spender ruins their credit and spends a decade recovering. Wealthy immigrants see money differently. Credit is a lever, debt is a vehicle, and every decision runs through one filter. Does this make me money or cost me money over time? That shift from debt is dangerous to what kind of debt is this is worth more than any investment tip I could give you. Good debt versus bad debt. Good debt appreciates or generates income greater than its cost. A mortgage on a rental property, a student loan that doubles your earning power, a business loan generating profit beyond its interest. Bad debt buys things that lose value the moment you buy them. A luxury car loan, credit card debt funding a lifestyle, buy now, pay later for clothes and electronics. Here's the counterintuitive truth. The wealthiest people in North America carry enormous debt. They're leveraged to the hilt, but every dollar works for them, generating returns beyond the borrowing cost. That's the engine of wealth creation here, and immigrants from survival-based economies have to rewire what debt means in this context. What financial beliefs did you bring with you that might be limiting you right now? Drop a comment. I read every single one. Optimizing your credit card. Used correctly, your card is a cashback machine. Put every monthly expense you'd already pay in cash onto it. Groceries, gas, bills, then pay the full balance every month. A household spending $4,000 a month earns nearly $1,000 a year at just 2% cash back. Over 10 years, that's close to $10,000 back for spending you were doing anyway. Power users stack cards. Groceries on one, gas on another, dining on a third, plus a welcome bonus card. I know immigrants who funded business class flights entirely through points, but this only works if you pay in full every month. Carry a balance and the interest erases every reward and then some. Why Maria's savings hurt her. Maria's $22,000 sat earning 1.5% while inflation ran higher, losing purchasing power every year. Worse, that $22,000 could have been a down payment in 2013 on a Toronto condo worth $280,000, now worth over $700,000. Leveraged through a mortgage, it would have generated over $400,000 in equity. Instead, it sat in a bank account and shrank. This is the cost of financial invisibility combined with fear of leverage. Lines of credit. A line of credit, personal, or a HELOC against home equity, is revolving. You draw what you need and only pay interest on what you borrow. Personal lines run 6% to 12%. A HELOC can be as low as 5% to 7%. Far cheaper than a credit card at 19.99%. 3 strategies. The investment bridge. Draw to seize a time-sensitive opportunity. Repay as cash frees up, paying a few $100s in interest to access an opportunity worth far more. Debt consolidation. Roll $15,000 of 20% credit card debt into an 8% line, saving roughly $1,800 a year. But you must freeze those cards, or you've doubled your debt. And the emergency fund alternative. Keep your cash invested and use an open, unused line of credit as your backup instead of parking money at 1.5%. Advanced, but real. If you're finding value here, share this with someone who needs to hear it. Real estate and leverage. Real estate is one of the most accessible wealth tools because of leverage. You can control a $600,000 asset with just $30,000 to $60,000 of your own money. Buy a $500,000 property with a $50,000 down payment. It appreciates 5% in a year, and your $50,000 just generated $25,000 in equity. A 50% return on your actual cash, because you control the whole asset. This is why real estate has built more generational wealth for immigrant families than any other asset class. But lenders look at your credit score, not just income. I've seen great incomes denied at a 620 score and modest incomes approved beautifully at 780. Your credit score is your ticket in. If your credit score determined whether you could buy a $600,000 asset with $60,000 of your own money, would you treat building that score as a priority starting today? Business credit. For entrepreneurs, most immigrants fund their entire business on personal credit, which maxes out the score you need for a mortgage and creates real tax and legal risk. The right approach is to incorporate early, open a business account and card, and build a credit profile that belongs to the business itself. Within 2 to 3 years, a properly structured business can access financing on its own credit and cash flow, lines of credit, equipment financing, commercial mortgages, through the entity, not your personal guarantee. And the interest on business borrowing is tax deductible, dropping your effective cost while that capital generates 10% to 15% returns elsewhere. That spread is pure wealth creation, legal, ethical, and exactly what sophisticated builders do. Credit recovery. If your score isn't where you want it, it is never too late to reset. I've watched people recover from 580 in bankruptcy to 780 in mortgage approval within 3 to 4 years. Negative items lose impact after 2 years and fall off entirely after 6 or 7. The sequence: stop adding negative marks and pay every current bill on time. Address collections, negotiating pay for delete where possible. Add positive trade lines, a secured card, a credit builder loan, or becoming an authorized user on a trusted family member's account. Then be patient. Consistency over time matters more than any single move. Think of your score as a construction project, brick by brick, every month. Kwame's story. Kwame arrived in Vancouver from Ghana in 2014 with $3,000. He built credit methodically for 18 months, hit a 720 score by year 2, 760 by year 3. That year, he borrowed $15,000 at 9% to invest in index funds. The market returned 11%, netting him $300 after interest and a valuable lesson in leverage. He scaled it up the next year. By year 5, he had a 780 score, $40,000 in investments, and pre-approval for a $520,000 mortgage. He bought a house, rented the basement for $1,400 a month, and used that to overpay his mortgage. Today, he owns 2 properties, runs a tech startup, and has a net worth north of $800,000. 11 years after landing with $3,000. He wasn't lucky. He had information and the willingness to use the system instead of fearing it. Cash flow management. None of this matters without disciplined cash flow. Live by a zero-based budget. Every dollar has a job before it arrives. 50% to needs, 30% to financial advancement, 20% to quality of life. Within that financial advancement bucket, sequence matters. Capture your employer match first. It's free money. Build a small starter emergency fund. Eliminate any debt above 8% interest. A guaranteed return. Maximize tax-advantaged accounts like your TFSA or Roth IRA. Invest in low-cost index funds. Then position for real estate or business. Followed consistently, this sequence builds millionaires out of ordinary earners over 15 to 20 years. Interest rates and remittances. When rates are rising, lock in fixed rates on long-term debt like a mortgage. When rates are high and expected to fall, variable rates let you ride the decline down. For cards and lines of credit, rising rates make carrying a balance more expensive. So that's exactly when you want a zero balance. And if you're sending money home every month, structure it as a fixed budget line, not an open-ended obligation, and use low-fee transfer services instead of traditional wires that charge 5% to 8%. On $500 a month, that fee gap alone costs you hundreds of dollars a year for nothing. The greatest gift you can give people back home isn't a monthly transfer. It's building enough wealth here to eventually lift the entire family. Advanced leverage and financial identity. Once your credit profile is solid, above 720, clean history, you can access strategies like the Smith maneuver in Canada, converting mortgage interest into tax-deductible investment loan interest, or margin lending against a portfolio. Higher risk, but it illustrates the point. Every level of wealth creation involves leverage. Build up gradually: secured card, line of credit, mortgage, business credit, investment leverage. Skip steps and you fall. Build methodically and you climb higher than most in your family's history ever have. And update your financial identity. Most immigrants carry beliefs formed in childhood scarcity. That identity served its purpose elsewhere, but it will suffocate you here unless you consciously choose a new one. I am someone who uses money as a tool, who builds assets, who thinks in decades. Keep your parents' wisdom about hard work. It's gold. Layer financial literacy on top of it. You are the bridge generation. You didn't cross an ocean to live paycheck to paycheck in one of the wealthiest countries on earth. The system exists. The tools exist. They are not reserved for people born here. They are available to anyone willing to learn and apply them with consistency. Build your credit starting today. Use cards as cashback tools and pay in full every month. Open a line of credit before you need one. Borrow to invest in appreciating assets. Eliminate high-interest debt. Save in tax-advantaged accounts. And believe this is possible for you, specifically with your income and your timeline. Maria eventually bought her condo. It took 3 more years after that rejection, but she came back with a 740 score and a pre-approval letter and walked into that bank like she owned the place. Because she did. Your time is now. The game has rules. You know the rules. Go play it. If this opened your eyes, hit like, subscribe, and share this with someone in your community sleeping on their potential. Drop a comment. What's the one strategy you're implementing in the next 30 days? I'll see you in the next one. Keep building,